All right. I think we would like to get started. As more people join, they will find us in the middle. So good morning to all of you attendees, colleagues. Good afternoon to you. Good evening to you, depending on where you are. Just to say, or just to let you know that we have got about 600 people who have registered for this webinar, which is quite great, which is a record. Now, a bit about me. My name is Michael Tchareva. I will be the moderator for this session. I am, my role, I am the chair of the IAA Banking Virtual Forum. I'm also the chair of the Actuarial Society of South Africa Banking Committee. Some of you would have already encountered me because we have done a number of webinars as we try to promote banking, as we try to show opportunities for actuaries in the banking space. And today we have got two great speakers here. Ian Allen, when they come in, I'm going to ask them to introduce themselves. So it's Ian Allen, a very experienced banking actuary, banking professional with more than 40 years in banking. And then we also have Yash Ratanpal, also very experienced. I first met Yash in India. I had to go there to meet him when he was still, getting into the banking space. So Yash and Ian will take us through the topic we have today, which is measurement and modeling of interest rate risk in the banking book. We only have got 1 hour in the same format we did last time when we did recovery and resolution planning. And so it's 1 hour. But for this session, let me say to you, the more exciting thing is today we're going to deal with the principles, and then we are going to hold another session, maybe in the next 2 to 4 weeks, on a practical example to illustrate interest rate risk in the banking book, how to measure it, how to model it. And Yash and Ian will come back again in a second session because it is proving to be a very popular session. With that, I would like to hand over to Ian and Yash, but please keep your questions, post your questions in the question and answer section. We will probably leave a few minutes at the end, probably 5 minutes. This is quite an interesting topic, quite a technical topic, but we will leave some time for questions so that Yash and Ian can come and answer some of the questions. Otherwise, please enjoy the session. It is one of those series of webinars that we are doing on the banking space, and enjoy. Ian and Alan, I would like to hand over to you. If there is any housekeeping, Nancy, that you may want to do, this is the time to do it so that we give to Ian and Alan and we get on with business. Thank you very much.
Thank you. For housekeeping, please note that verbal capabilities have been turned off due to the sheer number of attendees. So please post your questions in the Q&A. You'll see the icon at the bottom, and please post them there. And note that the slides and the recording will be made available on the IAA website within the next day or two. So if you wanted to share them, please, you're welcome to do that. Okay, go ahead, Ian.
All right. Thank you very much, Nancy. So over to you, Ian and Yash. I leave it into your hands now. Thank you.
I'm going to just set the context and then Yash will go through it all. As you all know, there are two main areas in banking: investment banking and what we call commercial banking, retail and corporate. Investment banking, M&A, securities trading, we're not going to look at that today. Commercial banking, loans and deposits and payments for retail and corporate customers. Investment banking and commercial banking, I worked in both of these. Investment banking for UBS, commercial banking for the Scottish Bank, RBS, now known as NatWest. Many large banks, of course, including the ones I work for, cover both investment banking and commercial banking. Broadly corresponding the two areas, large banks have a trading book and a banking book. They are accounted for in different ways. In the trading book, there's lots of market risk. Assets and liabilities are marked to market. However, in the banking book, loans and deposits are regarded as being held to maturity they are not marked to market. So banks should hold capital for what we're talking about today, interest rate risk in the banking book. And this is a very important fundamental risk in banking, because commercial banks do not match loans and deposits, assets and liabilities in the way that pension funds do. Typically, banks borrow short and lend long. The phrase used, for example, banks might fund mortgages with short-term deposits. This is not as risky as it sounds because of behavioral maturities versus contractual maturities. So instant access deposits may remain with banks for years and years, whereas mortgages are often repaid long before the contractual maturity dates. However, deposits may be withdrawn and banks are exposed to liquidity risk. They hold some liquidity, but if withdrawals exceed that, banks can't ask for immediate repayment of their loans. And as you know, that can, in the worst case, turn into a run on the bank. And that's what happened to Silicon Valley Bank in March last year. Silicon Valley Bank had used some of its deposits to invest in longer-term bonds. As interest rates went up, they had unrealized losses. There was some outflow deposits, not particularly worrying or surprising because SVB had grown its deposits very rapidly, but it did announce that it had sold securities at a loss, that it was planning a capital raise. Confidence evaporated, and quite remarkably, in an online world, SVB lost 85% of its deposits in a single day, and the bank failed. More generally, in a report on the banking crisis, the Basel Committee talked about fundamental shortcomings in the basic risk management of traditional banking risks, such as interest rate risk in the banking book. Not as serious as SVB, but worthy of attention. So following that mini banking crisis last year, many banks are reviewing their interest rate risk in the banking book, looking at the capital and the modeling and measurement, and looking at their governance controls. So this is a clear opportunity for actuaries who are interested in banking, like many of the people who have joined us today. So Yash is going to take us through this, telling us what we need to know if we were going to do work on IRRB for a bank, either as an employee or as a consultant. Over to you, Yash. Thanks.
Thanks, Ian. Thanks, Michael, for organizing this webinar on a very important topic and having me over to speak on it as well. And thanks to everyone who's joined in. It's great to see a very large turnout today on this very important topic, which has become extremely relevant in the last few months or years. So I think just to cover and give you all a broad overview of what all are we planning to cover in today's session. We'll start off with giving a brief overview of the banking business model, where I'll talk about what are some of the key risks faced by banks today. How has the banking business model changed over time? And at the fundamentals, what is the definition of IRRBB for banks? What are the various components of IRRBB and what is its impacts on banks? After that, we're going to talk about the revised Basel standards on IRRBB, which is the SRP 31 Basel regulations. And we're going to speak about the various principles in the guidelines on IRRBB, covering various areas ranging from risk governance and oversight to IRRBB measurement, modeling and stress testing, followed by data integrity, model risk management, and capital adequacy assessment for IRRBB. And lastly, also covering reporting, disclosures, and the entire supervisory review process. We'll also briefly cover an illustrative case study on IRRBB from an EVE perspective, while today's session is more to cover the principles and the fundamentals of IRRBB as a concept. As Michael mentioned earlier, we will be organizing a more detailed technical session where we'll be talking about the nuances of the IRRBB modeling in a separate session. But for today, we will touch upon a brief case study to give everyone a flavor of what does IRRBB modeling mean in the banking context. And finally, we'll be talking about some of the challenges and opportunities that banks face when it comes to IRRBB measurement. And what does that mean for the actuarial fraternity? And how can this be seen as an opportunity for actuaries to enter the banking industry? And we'll take the last 5 minutes for Q&A. Right. So I'll start off with the first section, which is giving an overview on the banking business model. Traditionally, when the banking industry essentially started off, the core business model of the bank has been fairly simple to understand. Banks raise money through various liabilities, such as deposits, borrowings, and they also have their own internal capital that they use to raise money and borrow money from various different sources. And banks pay the interest expense on these liabilities. Now, using the money that the banks raise from these various funding sources, they generate assets in forms of primarily loans and advances, and they also invest in other kinds of investment assets that form a part of the assets on their asset sides. And essentially, banks make an interest income from these assets. So essentially for a bank, the difference between the interest income that they earn on the assets and the interest expense that they pay on the liabilities, the difference between that is called the net interest income, or the NII. And that is a very key important contributor to bank's profitability, because that's essentially how the bank remains profitable, that the interest income should continue to remain higher than the interest expense. At the core of the banking business model, that's essentially how banks primarily work. However, over a period of time, banks have diversified their business models. Today, banks are not just focused on the core deposit and loan business models. They're also now looking at other areas to generate income, which means that in today's day and age, an income for the bank, or the overall profitability for the bank, is not just primarily driven by net interest income or NII. It's also driven by other forms of income, such as income from trading in different asset classes, advisory fee and non-interest income from investment banking, underwriting, M&A activities, and also from various other fee income-based services, such as transaction banking, wealth management, and other services. However, even today, even though banks have diversified across various such models, the majority of the profit that the bank typically, or the main driver of the profitability continues to be the NII, arising from the banking book, or the core banking book, or the core business model of the bank. And when we speak about IRRBB, this is the area that we are primarily focused on today, right? Which is how essentially does interest rate risk manifest within the core banking book of the bank, and what can banks do to model and measure this interest rate risk from their perspective. Just a summary of various risks that banks face. Of course, today's session is focused on interest rate risk, but primarily in today's day and age, banks are faced with various types of risks, ranging from credit risk to market risk to operational risk, liquidity risk, profitability risk, and a lot of new age risks such as climate risk, model risk management, digital banking risk, so on and so forth. While we will do hopefully we'll do different webinars on these topics separately, but today's focus is primarily on interest rate risk and aspects of liquidity risk, because when we speak about IRRBB, it's a confluence of interest rate risk and liquidity risk, covering prepayment risk, early redemption risk, and also cash flow gap risk, and the interaction of liquidity risk and interest rate risk coming together. Talking about what exactly is IRRBB. Primarily, the way Basel has defined IRRBB is interest rate risk in the banking book, or IRRBB, is primarily referred to as current or prospective risk to a bank's capital, as well as to its earnings, arising from impact of adverse movements in interest rate risk. What that means is, when we speak about IRRBB, we talk about two aspects very clearly. One is the impact of interest rate risk on the net worth of the bank, which is also known as the impact on the bank's economic value. And the second aspect is the impact of interest rate risk on the bank's earning, which is kind of measured through NII. So IRRBB is a double-edged sword. When interest rates move, it impacts both the net worth as well as the earnings of the bank. And the way it impacts the economic value and earnings of the bank are primarily related to each other. But at the same point in time, banks need to manage both economic value and earnings when interest rates in the market change. So it's not that when interest rates change, we are only focused on NII or earnings. We also need to look at the impact of interest rate changes from an economic value or from a net worth perspective. Primarily from the perspective of components, IRRBB has three main types of subcategories of risk. The first kind of risk within IRRBB is called gap risk, which essentially arises from difference in the term structure and the timing of rate resets between interest rate sensitive assets and interest rate sensitive liabilities. What that would mean is that there are the rate speed, the speed at which interest rates change on the liabilities is different from the speed at which interest rates change on the asset. That means that there could be a gap in the timing and the quantum of the interest rate sensitivity between assets and liabilities. And while your assets could be getting repriced earlier or later, your liabilities would not be exactly repricing exactly as per the timing of the assets. The second type of risk within IRRBB is basis risk, where we are referring to with basis risk essentially refers to the correlation risk on financial instruments that have similar tenors but are priced using different interest rate indices, which means that even if they're getting repriced at the same amount of time or the same period of time, the underlying indices could be different. For example, one asset could be priced off by LIBOR, but maybe the liability that's funding that asset could be priced off using US treasuries. So the way the market determines the interest rate dynamics and the different indices can differ. And hence, there's a basis risk between the different interest rate curves on the assets and liabilities that can lead to an interest rate risk mismatch. The third category of IRRBB is called optionality risk. And within that, there are two main kinds of subcategories. There's an automatic option risk and there's a behavioral option risk. Automatic option risk exists through embedded derivatives within the loan book, such as banks offer several loans with caps and floors. These are embedded options that automatically get triggered as and when interest rates change. And the second types of options are behavioral option risks, which are essentially behavioral factors by the customers on the loan portfolio or the deposit portfolio, such as prepayments on loans or early redemption on deposits. And how do these behaviors change across different interest rate scenarios? And how can these behaviors adversely impact the bank? All three types of these IRRBB risks primarily manifest into two types of impact that we spoke earlier. One is the impact on economic value, which is the net worth, which is essentially the present value of all the future cash flows of the banks arising from banks' assets, liabilities, and off-balance sheet instruments, right? And the second part is essentially the impact on earnings, which is the change in the interest income and the change in the interest expense, which impacts the overall NII of the bank and also inevitably the overall profitability of the bank. Moving on to the next section, where we're going to now talk about the revised Basel standards for IRRBB. What I'm going to first talk about is how IRRBB regulations have evolved over time. Interest rate risk is not a new risk on the block. The concept of interest rate risk has been existing for a very long time, and probably since the advent of banking. But Basel came out with its first paper on principles of management of interest rate risk in September 1997. After that, they released a revised version of the 1997 paper in January 2001. Post that, they updated the principles again in 2004. And after that, they came up with a consultative document in 2015 and the final revised IRRBB standards, which are a more advanced way of computing and managing and modeling IRRBB in banks in 2016. And very recently, in December 2023, they've come up with a consultative document to even recalibrate the severity of interest rate shocks given the experience that we've seen across the globe over the last 1 to 1.5 years. So Basel has been monitoring IRRBB fairly regularly, and there are consistent updates from Basel's side on the IRRBB guidelines, which is extremely critical for banks to follow and manage in their respective jurisdictions. Some of the key highlights of the revised standards are as follows. The new IRRBB standards that banks need to follow focus on both EVE as well as NII. The revised framework requires banks to do a very holistic and comprehensive stress testing using 6 supervisory shock scenarios at the bare minimum. The bank, while the standard offers a very revised standardized framework, the bank also has an option to follow an IMS approach, which is also called as an internal measurement system approach, wherein the bank can use their own models and their own IRRBB framework instead of using the standardized framework. However, failure of not meeting the regulatory requirements or sophistication as per the standard, as per the IMS, can lead to mandatory adoption of the standardized framework. And it goes without saying, both the standardized and the IMS frameworks needs to go through a very rigorous independent model validation process. From the perspective of disclosures, the new standards require very extensive qualitative and quantitative disclosures to ensure peer-to-peer comparison between various banks. And it's not just a checkbox exercise anymore. There is also outlier tests that are performed as part of the revised standards, which say that if the bank's sensitivity of their economic value or EVE is more than the 15% of bank's tier 1 capital, they essentially will be termed as an outlier bank. And there will be several repercussions on the bank's strategy, on bank's capital raising plans and bank's hedging strategy that would need to be incorporated by the bank to ensure that they don't breach the threshold. So the high-level summary of how Basel has evolved and a high-level view of some of the key aspects of the revised standards. Getting into some more detail on exactly what do the revised standards mean. There are primarily 7 key principles that the revised standards focus on. Each of these 7 principles are listed on the slide here. And what we're going to do is we're going to delve deeper into each of these 7 principles across the remainder of the presentation, and understand exactly what are the requirements of the new guidelines and what do banks need to do to adhere to this guideline and also ensure that IRRBB measurement and modeling is done in an optimal manner. The first one is on risk governance and oversight, which involves banks accurately identifying and monitoring exposures, which are IRRBB sensitive exposures, ensuring that banks have a very comprehensive and robust IRRBB policy, and banks have a very specific and explicit risk appetite statement and policy limits for various IRRBB metrics, which is for both economic value as well as for NII. And there's an extensive focus on governance from an IRRBB perspective in the guideline, when banks need to kind of look at rehauling their governance framework and have a dedicated IRRBB team to manage the entire IRRBB risk management process. The second aspect is on measurement and modeling, where banks need to use standardized models or internal models to compute and model economic value and earnings-based measures. And there's a lot of emphasis on behavioral modeling as part of this particular guideline that banks need to focus on. We then have stress testing framework, where banks need to adopt the supervisory stress scenarios for stress testing. And over and above that, they also need to define their own internal stress scenarios. Model risk management is another very important principle, which is important for IRRBB, because IRRBB requires banks to develop a vast set of models. And all these models need to go through a very rigorous model risk management and a validation process, which should be covered under the model risk management principle. The outputs from IRRBB also need to get integrated with the capital adequacy assessment framework. So there needs to be a clear linkage between ICAP and IRRBB computations. And that's why there's an entire principle dedicated on capital adequacy assessment. And lastly, it's on reporting and disclosures and supervisory review, where there are both detailed qualitative and quantitative disclosures that banks need to produce. And for supervisors in various jurisdictions, there's a very strict outlier test that regulators across the globe are currently doing to identify banks that are breaching the threshold set by BCBS. What we're going to do now is delve deeper into each of these principles that I just showcased, starting off with risk governance and oversight. When we speak about risk governance and oversight of IRRBB, there are primarily different aspects that a bank needs to look at. The first thing banks need to do is they need to have a clear delineation between the banking book and the trading book exposures, because this guideline is only applicable for banking book exposures and not trading book exposures. Banks need to ensure that every new product that they roll out, there's a detailed product note that is made out, and the IRRBB risks within that product are very well understood before they're rolled out. There's also a need for banks to identify CSRBB within each of these respective products. CSRBB specifically stands for credit spread risk in the banking book. And what the new guideline is trying to do is trying to bifurcate IRRBB into pure interest rate risk and then the credit spread risk element. So banks need to bifurcate the risk measurement and the risk management processes to show the numbers separately for IRRBB as well as CSRBB. From a delegation and resourcing perspective, there needs to be a separate governing body from a governance perspective that will look at the entire IRRBB function on a day-to-day basis of the bank. There needs to be a proper policy, a very holistic policy for IRRBB that needs to be created. And IRRBB can't be looked at only in isolation. The bank needs to look at IRRBB along with market liquidity, credit, and operational risk, and the potential linkages of interest rate risk and the other risks. There needs to be a specific risk appetite statement that needs to be defined by the bank, and there needs to be specific risk limits that the bank needs to decide and calibrate at not only at aggregate level of the firm, but also at an individual business unit level, at a portfolio level, at an instrument level. And each of these need to have specific thresholds. And whenever there is a breach in the thresholds, there needs to be a specific plan in place to escalate them. And the last part is on internal control and audit. The entire IRRBB management process needs to be audited on a regular basis, either both by an internal and an external auditor. And these reports of auditors needs to be made available for the supervisors during the supervisory review. Talking about the second principle, which will be of interest to most of the actuaries who joined the call, which is on IRRBB measurement and modeling. When we talk about IRRBB modeling, there are various types of measurement approaches that have evolved over time. And simultaneously, even the assumptions that banks are using from the perspective of forecasting their balance sheet has also changed over time. Initially, banks started with simplistic measures like repricing gap analysis and duration gap analysis, and also measures such as PVO1, to get a broad level assessment of what is the interest rate risk in their banking book. And in case of parallel shock scenarios, what would be the impact on their economic value and their NII. However, these measures lack the granularity and also were not capable of addressing non-parallel interest rate shock scenarios, which is what we see as a reality in the market today. So to address these concerns in the new guidelines, there are specifically two measures that BCBS has asked banks to focus on. One is the EVE, and the second one is the NII. EVE simulations are essentially full revaluation of the entire banking book and recomputation of the economic value of equity under both parallel and non-parallel interest rate shock scenarios. And NII are granular NII simulations across, again, both parallel and non-parallel shock scenarios using various different balance sheet assumptions. From a balance sheet projection perspective, banks traditionally used a runoff balance sheet approach, wherein existing assets and liabilities run off. When they ran off over a period of time, they were not replaced after maturity. But with the introduction of IRRBB now coming into play, banks are also now evolving to look at constant and dynamic balance sheet approaches to ensure replacements of assets and liabilities as they mature under a constant balance sheet approach, or looking at a more dynamic and sophisticated and forward-looking balance sheet modeling approach, which is called as the dynamic balance sheet, wherein the balance sheet evolves over time and interest rate risk is seen throughout the evolution of that balance sheet. Today's session is focused on the last two matrix, which is on EVE and NII simulations, which is primarily the key focus of these revised guidelines. Let's understand what is EVE and NII and how are they different from each other. Primarily, EVE and NII differ from each other on three counts. The first is the outcome. When we speak about EVE, EVE measures the change in the net present value of the bank's assets, liabilities, and off-balance sheet items under different interest rate shock scenarios. In simple terms, EVE is nothing but the present value of the entire bank's balance sheet, and how does the present value of the bank's balance sheet change under different scenarios. Also, a good measure of the net worth of the bank. While NII refers or measures the profitability of the bank over a given time horizon, right? It refers to the net interest income, which is the delta between interest income and interest expense, which is the core profitability driver of a bank, and how does that profitability metric change over a period of time. While EVE is seen as a more longer term measure of risk because it's seen throughout the entire period of while the time your entire balance sheet runs off, NII is typically more to a short to medium term risk measure from a 1 to 3 to 5 year horizon, right? So while EVE captures the entire life of the bank's portfolio, NII will typically capture the profit horizon for the next 3 to 5 years. In terms of balance sheet assumptions, EVE is always computed on a run-off balance sheet assumption, which means that the balance sheet is assumed to run off. And we want to see that if the balance sheet runs off, what is our net worth of the bank today? While NII, on the other hand, is actually always computed on either a constant balance sheet or a dynamic balance sheet assumption. Because essentially, if you let the balance sheet run off under NII, your interest income that's getting computed is not the right measure, because we need to look at the interest income when assuming the balance sheet size is realistic and remains constant or dynamic over a period of time. What is important to understand here is the BCBS has made a very important comment that IRRBB needs to be managed through management of both economic value and earnings-based measure. If a bank only minimizes its economic value risk by matching exactly the repricing of its assets with liabilities beyond the short term, it will lead to an impact on earnings volatility. And this is a very important statement to understand, which means that, and that's why I go back to saying that IRRBB is a double-edged sword. If we try to perfectly minimize or optimize our EVE, it will lead to volatility on our NII. Right? That's essentially how these measures are created, because EV is a more longer term measure of your net worth and resilience of the bank, while NII is a measure of a short term profitability. And there's always going to be a trade off between long term resilience and short term profitability. And the bank needs to be very careful in maintaining a very thin balance between both EV and NII so that both of them are managed in equilibrium. The other aspect when we speak about, so now that we've understood EV and NII, the other aspect that we need to talk about is on behavioral modeling. This is a very important addition to the recent IRRBB standards. The recent IRRBB standards require banks to calibrate behavioral models extensively and capture various types of behavioral risks. One of the key things that we've observed over a period of time is that when interest rate risk changes, the behaviors of our customers also change from a banking perspective. And when the behaviors of our customers change, it inevitably leads to a liquidity risk or a liquidity impact on the bank's portfolio. Some of the risks that the Basel guidelines have asked banks to cover specifically. The first one is on prepayment risk, which is the risk of early prepayment on loans across different interest rate shock scenarios. Generally, if interest rates decrease, the borrowers will increase the speed of prepayment because they're able to refinance the loans at a lower rate of interest. Similarly, we talk about early redemption risk on the deposit side, that when interest rates increase, depositors will try to increase the speed of and redeem their deposits earlier than expected so that they can get higher returns and other deposit opportunities, right? There's also drawdown risk, which is banks may sell options to retail customers in cases such as mortgage buyers, whereby for a limited period of time, the customers can choose to draw down a loan at a committed rate. And as the interest rates change, the drawdown rate or the speed of drawdown can change across different interest rate scenarios. And then we have the NMD volatility risk, which also stands for non-maturity deposits, where current and savings accounts in the deposit customer of the banks, which are your current and savings accounts, they actually don't have any maturity date, and they can be withdrawn at any point in time. And as interest rates change, banks or the customers of the banks can actually modify their withdrawal rate and at the speed at which they're withdrawing their deposits. Now, what this would mean is any of these risks, as interest rates change, the customer can come and kind of pull out their money from the bank or inject new money in the bank. And both of them can have significant impacts from a liquidity risk management perspective. And that's why when people talk about IRRBB, while IRRBB's key focus is on interest rate risk, it also looks at how changes in interest rate risk will have an impact on the liquidity position of the bank, which is a very important risk to understand. Because in most of the recent events that we've seen that while banks can withstand other kinds of risks, liquidity risk is one risk that takes them out in a very short period of time. And there are significant runs on banks that banks can do nothing about over a short period of time. As per the guidelines, for each of these various types of behavioral risks, there are various behavioral models that banks need to develop and calibrate. And there's a very specific emphasis on macroeconomic modeling, right, for these various risks that banks need to cover. So there are various macroeconomic variables like stock indices, unemployment rates, GDP, etc., that need to be looked at to calibrate these behavioral models. That means now banks can't just look at subjective assumptions to come up with these behavioral models. They need to actually calibrate scientific and forward-looking macroeconomic models, statistical models, which are very robust and sound, to predict these behavioral patterns based on historical data and trying to come up with forward-looking trends to help the bank in managing their IRRBB risk. The next principle that we speak about is on stress testing. As per the guideline, there are 6 shock scenarios that banks need to, at the bare minimum, completely stress test their balance sheet on. There is a parallel shock up scenario, there is a parallel shock down scenario, there's a steepener scenario wherein short rates go down and long rates are up. There's a flattener scenario wherein short rates are up and long rates are down. There's a short rate shock up only scenario and there's a short rate shock down scenario. Until a few years ago, primarily the focus was on parallel shocks. However, with the advent of the new IRRBB guideline coming into play, now we also need to look at non-parallel shock scenarios, which is a reality in what we see in the economic markets. There are different interest rate shocks that Basel has prescribed for different currencies, because every country and every jurisdiction and every currency has exhibited a different kind of interest rate volatility that needs to be taken into account when we are doing our balance sheet projections. Because banks have exposures in multiple currencies, not just a single currency. So for each of the currencies, there are different shock parameters that need to be taken into account to come up with these shock scenarios. This is an illustration of some of the shock scenarios for parallel shock ups. These are the tenor points and these are the level of the interest rates. And this is for parallel shock up. These are for short rate shocks down. These are for rotational shocks like steepeners and flatteners. The bank needs to shock each and every interest rate curve in their balance sheet for each and every currency across all these 6 shock scenarios. And the entire stress testing of the balance sheet is conducted at the bare minimum using these 6 shock scenarios. In addition to these 6 shock scenarios, Basel has also asked banks to design their own internal scenarios. Banks need to look at a lot of other factors like shape and level of the term structure of interest rates, historical and implied volatilities, scenarios such as non-parallel gap risks, option risks. They need to look at new products and new markets where historical data is unavailable, and also do a lot of reverse stress testing from their perspective to come up with more shock scenarios from their side. Today, there are banks in the industry that are maintaining more than 30 to 40 internal scenarios over and above the 6 standardized shock scenarios that Basel recommends the banks to adopt. So IRRBB is not just about standardized shock scenarios, it's going over and above on interest rate shock scenarios, on your internal shock scenarios as well, which form as part of your pillar 2.
Yes, if I can just interrupt there. This is really impressive and comprehensive. So people on the call should be saying, how come SVB failed? So just to add in a bit of detail, in Basel, there are 3 pillars like Solvency II. In pillar 1, you do the basic risks according to the Basel regulations. But IRRBB, as Yash has said, is looked at under the pillar 2 supervisory review process because it's so different between banks and because it needs stress testing, which is done under pillar 2. A disadvantage of this approach, which the Basel Committee has recognized, is that it can lead to different outcomes in different jurisdictions. And in the US, it happens that for smaller banks, the accounting rules didn't require them to have capital for losses on bonds. And in 2023, they hadn't had to do a stress test. So these US banks, SVB and one or two others, were special cases. This was not a system-wide meltdown like 2008. These are special cases. It does, however, make the point that Yash is emphasizing on this slide. You can't just rely on the regulations. You can't have regulations, however prudent, however sensible, something you can turn up. So doing banks' own stress tests is really important and a very interesting area for us as actuaries. Thanks, Yash.
Thanks, Ian. Thanks for that. I think moving on to the next principle is on model risk management. There are several models that are required throughout the entire IRRBB process. There are balance sheet projection models, there are interest rate forecasting models, there are behavioral models, there are models for embedded optionalities, there are FX and volatility forecasting models. Each of these models are statistical and very significantly mathematical in nature, which means that the entire IRRBB process is under a lot of scrutiny from a model risk management perspective. The new guidelines emphasize a lot on having a very strong model risk management process and following a very rigorous model validation process, covering data integrity, conceptual soundness of these various models, and also ongoing model monitoring. Which essentially means that banks need to keep a repository of all the IRRBB models, and there needs to be regular backtesting, regular documentation, regular recalibration, and validation of all the models that are currently being in use. We now talk about capital adequacy assessment. The outcome from IRRBB needs to be linked to how the bank is setting aside capital. At the end of the day, the entire reason why we are doing the exercise of IRRBB is to understand that if interest rate scenarios move, how much capital does the bank need to keep aside to safeguard themselves against interest rate changes? Banks need to keep aside capital from an ICAP perspective for both economic value of equity as well as for NII, so that if your economic value of equity or NII is sensitive to interest rate changes, there is sufficient capital kept aside to safeguard the banks from those changes. And it directly gets linked to the Pillar 2 requirements that Ian was referring to, which is the ICAP requirement for banks.
Yes, I've worked a lot in ICAPs, Yash, and I would just say on that ICAPs are done normally by a small team, a multidisciplinary team, people with different risk management backgrounds. And I find as an actuary, you can really add value in that. I hate sometimes discussions about bankers are better than actuaries or actually better than bankers. It's a multidisciplinary team with complementary skills. The particular things that we as actuaries can bring in doing ICAPs is our enterprise-wide understanding of risk. We can see across the whole business. We can work with specialists in different areas, and we can contribute to this discussion about making forward-looking judgments as well as complying with the regulations. So I found ICAPs more generally a very interesting opportunity for actuaries as well as a specific topic of IRRBB. Thanks, Yash.
Thanks, Ian. That's very, very true. ICAP is definitely one area where actuaries can add significant amount of value for banks. We now talk about the reporting and the disclosure requirements of IRRBB. The guideline requires banks to adhere to both management reporting standards as well as public disclosures. What that means is there are internal MIS dashboards, detailed reports that need to be maintained internally by the bank and presented to their ALCO on a regular basis. In addition to that, there are also public disclosures that the banks need to put out on a regular basis, which are both qualitative disclosures as well as quantitative disclosures. These are some illustrative reporting formats that banks need to follow for IRRBB. Which means that if you look at the disclosures here, the qualitative disclosures require the banks to give a description of all the assumptions, the key model assumptions that they've taken for doing the IRRBB measurement process. That means the banks need to be extremely transparent on how they're measuring and computing IRRBB, and it's not just a checkbox or a tick box exercise. In addition to that, the quantitative disclosure is where banks need to report delta EVE for all the 6 scenarios, the previous period and the current period, and they need to compare it to the tier 1 capital of the bank. While the delta NII needs to be reported only for the parallel up and parallel down shock scenarios. While from a regulatory perspective, NII is only supposed to be done for parallel shock scenarios and EV is supposed to be done for all the scenarios. But there are several large banks from an internal practice perspective that also compute NII for all the shock scenarios. And both computation of EVE and NI can be extremely computationally intensive. And we'll get to why that's the case when we go through the more detailed technical case study in our next session or when we organize that. The last principle is on supervisory review, wherein after the entire IRRBB process has been completed, various regulators and jurisdictions collect all the required information from the bank, such as their NMD assumptions, their behavioral assumptions, the type of yield curves, the type of interest rate shock scenarios that they've used. They assess the bank's policies, risk appetite statement, thresholds, and essentially then also compare bank's sensitivity of delta EVE to 15% of their tier 1 capital. And if in the outlier test, we realized that the delta EVE across all interest rate scenarios, breaches the 15% of tier 1 capital, there are corrective actions that banks need to take to reduce the IRRBB exposure through hedging, either raise additional capital, either put constraints on the parameters used by the bank, or do a holistic improvement of their risk management framework. So that in a nutshell was essentially the key principles of the Basel guidelines on IRRBB. Very briefly, talking about a very high level case study on the standardized EVE calculation, which is a very important measure for EVE. We'll be getting into the details or the technical details of this in our next technical webinar. But just to give everyone a high level overview of what does EVE computation look like. As per the revised standards and the standardized framework, there are 5 steps for the banks to compute their EVE. Banks need to first start off with allocating their entire banking book into different positions like amenable, less amenable, and non-amenable, depending on the characteristic of the product that they're working with. After that, banks need to use their cash flow generation and forecasting models and bucketing models, along with the behavioral models, to forecast cash flows for each and every line item in their portfolio, covering loans, deposits, non-maturing deposits, and covering various types of risks such as prepayment risk and early redemption risks. In step 3, the banks now take the forecasted cash flows and discount these cash flows under different interest rate shock scenarios to calculate the economic value of equity under each shock scenario. And then the bank computes delta EVE, which is what is the sensitivity of EVE under different shock scenarios. We then essentially have the calculation of the standardized EVE measure, wherein the bank is essentially computing what is the maximum EVE, what is the worst case EVE that the bank can basically kind of assess under different interest rate shock scenarios. So this is a 5-step procedure that banks use, and this is the illustrative output that banks follow from an EVE perspective, wherein you can see that across different interest rate shock scenarios, across different currencies, the banks will compute the EVE, and they will compare that worst case EVE change to the worst case EVE to the 15% of tier 1 capital. So as you can see here, the 15% of tier 1 capital is being breached. Which essentially means that the bank is an outlier bank in this scenario. Talking about, I think we've covered IRRBB fairly holistically. Talking now about essentially what are some of the challenges and opportunities for banks in IRRBB, and how does this present a great opportunity for actuaries to enter the banking industry. IRRBB is a very rigorous process. Banks need extensive and sophisticated risk models for the purpose of IRRBB management. There is need for stochastic interest rate term structure models for interest rate modeling. There is need for statistical and regression models for behavioral modeling. There's a need for forward-looking models for balance sheet projection. There are option pricing models required for aero valuations or embedded optionalities. And essentially, with the other aspects which are there, that there's a need for a very rigorous model risk management perspective, right? Which means there is model validation that is required for IRRBB. There is new age compute and technology available now, which helps us to develop more sophisticated and robust models. And the reporting requirements of IRRBB are extremely cumbersome, which means that it's not just a text box exercise with the outlier test being there. Banks need to take IRRBB extremely seriously. And I think these challenges offer a great amount of opportunities for actuaries in the banking sector. And it allows actuaries to enter the banking sector because all of these areas fundamentally are places where actuaries can add significant value and help the bank throughout the entire IRRBB process. Given the functional skill sets that we as actuaries bring to the table, which is a confluence of finance, statistics, mathematics, and economics, IRRBB is a fantastic area for actuaries to demonstrate value to the banking industry.
Right, Michael, you're going to get any questions?
Okay, thank you very much, Yash. Yes, we had questions, and some of them I already answered. Actually, most of them I already answered them as Yash was speaking. They were a bit straightforward, not too technical, beyond my own understanding. So I have already answered them because I figured out that we may not have time. But thank you very much, Yash, for giving a great presentation. There is still, there isn't any question now.
Michael, I would just add in the minute we have, and Yash may have some final comments to make too, that
yes, I think, yeah.
What Yash is saying sounds quite complicated, but to repeat to us all, nothing in here is at all complicated for an actuary. What we need to be familiar with is the language of banking and the practice in banking. The thing that makes IRB really interesting is that it is quite complicated with all the options and behaviors, and it links to the other risks. So it can most directly cause liquidity risk. But when you come to the ICAP, looking across all risks, you have to see the knock-on effect beyond risk in another. So it is a central risk in banking. It's one where actuaries have credibility as asset liability managers, and it does link to all the other risks. So it's really interesting to hear the update from Yash. I certainly find this very useful if I'm helping a bank on IRRBB. Yash, do you have any final thoughts about how actuaries can help in this area?
No, I think no final thoughts from my side. I think essentially, I believe that actuaries can add tremendous value to the banking industry. And we see today actuaries entering the banking industry, with South Africa being a great example of how actuaries are adding value to the banking sector. So I think this is hopefully just a beginning of a wave across the globe where actuaries can add tremendous value. And IRRBB is a fantastic area where I strongly believe that we can demonstrate value to the banking industry. So looking forward to the next technical detail session. Of course, today's session was more at a fundamental principle level, but we will do a more technical detail session on the modeling aspects of IRRBB next time. And thanks for everyone to join in.
No, thank you very much, Yash, and thank you very much, Ian. Now, what's important here is how can actuaries showcase that they have these skills? So there was a question that I answered where someone asked the question, so insurance, Solvency II seems similar to Basel, and I did answer that question. And the question was, what are the challenges for actuaries in insurance to go and actually convince someone in the bank to say they have the skills? So what we need to understand is that Basel II was introduced in 2008. It was before Solvency II. So actually Basel II came before Solvency II, became a global standard in the insurance sector. And you would find that actuaries were already in the banking sector in jurisdictions such as South Africa and Australia. They were already being involved in Basel II. So what I would like to do here is to say to actuaries, all you need to do is to understand these issues such as what Yash and Ian were explaining here. What does it mean? What is IRRBB? What do you understand about it? Then go ahead and upskill yourself. Just read up on it to understand exactly what this is, so that you at least know and you can try to match with the skills you currently have. So that you at least know when you find a potential hirer who asks you this question to say, how can you add value? But these presentations, like Yash and Ian have just given here, are meant to equip you for you to see where you can find more information, where you can start talking about your skills that you can apply in banking. So in conclusion, I just want to say, Ian started off by giving the background and setting the scene, and he referred to Silicon Valley Bank and its failure. and he addressed the key principle of a bank's model, which is borrowing short and lending long, and in that case involved in maturity transformation. So there is always a mismatch between assets and liabilities, which leads to interest rate risk in the banking book. Then Yash came in and spoke about business models of a bank and how banks make money. He spoke about the risks faced by banks, in which IRRBB is a key risk in that area. So if you understand these issues, you can see that actuaries can add a lot of value. Yash went on to talk about how IRRBB impact both the economic value of the bank, which is the net worth, and also the earnings as measured by the net interest income. He then looked at the revised standards, Basel standards, focusing on both economic value and earnings measures. And he addressed these key principles, and he ended with that last slide on opportunities for actuaries. So what you actuaries simply need to do is to understand all these different elements of banking risk management, and make sure you read up. There is a lot of literature. Even the IAA Banking Forum itself has produced a paper before on opportunities for applying actuarial techniques in banking. I did post it somewhere, and if you go through it, you should be able to get some of the issues. And we are revising that paper as we speak. Right, there were now some questions. Is IRRBB calculated only by an actuary? The answer is not necessarily, but actuaries can add value. Then there was Nikos also asked, thank you for your responses, very useful, very keen to study the PDFs you've posted. So that was just a comment, and very keen to attend the next technical session. Thank you very much, Nikos. You can attend that. Then there was another point. Could you please suggest good books or a must read for actuarial students? Well, look, the Actuarial Society of South Africa, the Institute and Faculty of Actuaries are currently already offering a course in banking, which is also a fellowship. It is a principles subject with also an application subject on banking, where you can actually study. That is the best we can recommend for you, but you can also read other literature like Basel material, the paper I've already referred to. There is also a book by Murad Chaudhry. It's a very good book, Principles of Banking. It's Murad Chaudhry. It's Professor Murad Chaudhry. He has written a lot of books. If you search him, Professor Murad Chaudhry is in the United Kingdom. You will find that book also very useful. So far, that's what we have. And we have answered all the questions that have been asked, because some of them we answered them before. Thank you very much to our panelists, Ian and Yash, for a very insightful presentation. And thanks to Amali and Nance at the IAA. The ladies have been very useful all the time. We try to do a webinar. Thanks to them. And thanks to all the attendees where you came to this session. It is quite an interesting session. We will do the technical section next time. So please watch out for the notification that we are going to give you. Last question. So I got disconnected, missed out on the answer. Sorry about that. It's now time up. I would like to thank everyone else, wherever you are. Please let us meet you next time. And I would like to also remind you, apart from the next technical session on interest rate risk in the banking book, we also have 2 other sessions coming in 2024. The other one is on market risk, and the other one is on market risk, and the remaining one is also on operational risk. So we will see you soon. Thank you very much to all. Keep well. Bye-bye.
Thank you, everyone. Thank you. Bye.
Thank you.